Here's your money briefing for Tuesday, May 23rd. I'm J.R. Whalen for the Wall Street Journal. Consumers are digging deeper to pay for everything from diapers to food to handbags, even while we hear that the inflation rate ticks lower every month. Wall Street Journal reporter Suzanne Kapner joins us to explain why companies keep raising prices. So, Suzanne, inflation is considerably lower than where it was a year ago, but consumer confidence has also come down. Why are consumers feeling that way?
So there are a lot of signs in the economy that point to a potential recession. We've seen a lot of layoffs, especially among white-collar jobs. And the pace of inflation over the past few years has really crimped consumers' budgets. We saw in some recent spending data from the government, consumers are dipping more into their savings to make purchases.
So with consumers feeling more skittish compared to several months ago, why do companies feel comfortable still raising prices?
The companies that are able to continue raising prices are selling things that either consumers really need or really want. So it's either a sign of necessity or a sign of brand heat. Like your brand is so hot and consumers really want what you're selling, they're willing to pay up for it.
What are some examples of that?
Well, Kate Spade has this purse that's in the shape of a dog that costs $500. It is one of their best-selling handbags. And for a lot of people, that's not an inexpensive outlay, $500 for what is a really very novelty bag. It's certainly not a necessity, but they are, selling like hotcakes.
Where are we seeing this in terms of household products?
Well, Procter & Gamble said recently that consumers continue to spend even though it raised prices about 10% in the last quarter, and they're spending heavily on things like Pampers and Tide detergent and stuff they really need.
What kind of a situation is that putting consumers in?
Consumers are having to make choices, right? We're no longer in the kind of free spending days that we experienced as we just came out of the pandemic, a year or two ago. And consumers are really having to decide, how much they need or want something.
Now, over the past 2 years, we've often heard companies blame things like labor costs and supply chain constraints as reasons for them continuing to raise prices. Are those things still factoring into the price hikes?
Well, certainly, all kinds of costs continue to be elevated as inflation remains above pre-pandemic levels. But we are seeing some signs that the price increases might be going beyond covering those higher costs. In the first quarter, we had a lot of companies reporting margins that were growing for the first time in about 6 quarters, which suggests that the price increases are greater than their cost increases.
How much of this has to do with as long as consumers are willing to pay the price, companies will continue to charge that price?
Well, I think it's, what the market will bear. And it's sort of the way capitalism works, right? Is as long as consumers are willing to pay the price, companies are going to charge that price, and they're going to keep raising prices until they kind of see some pushback from consumers.
But does it seem like this is almost a dangerous numbers game for consumers? Are these companies running into the potential danger of reaching a tipping point where consumers are just going to balk and walk away?
Well, I think we saw with Disney announcing plans to close one of its experiential resorts at Disney World that it was very expensive and consumers were sort of not willing to pay that much. So you are starting to see some signs where consumers are balking and companies have to kind of walk back a little bit.
So you have weary consumers whose wallets have been stretched thin and their overall outlook has soured. What are companies getting out of raising prices?
Well, it's a sign to investors and the stock market that your brand is strong. So like Tapestry, which owns Coach and Kate Spade, they talk about brand heat. And they actually started their price increases before the pandemic. It had nothing at the time to do with inflation. They were trying to elevate their brand by reducing supply, reducing discounts, improving quality, and all of those things allowed them to raise prices. And it's a sign that your brand is hot, and that is something that companies want to signal to investors.
And we've had periods of rising prices and maxed out consumers before. Is there a history lesson companies could learn about how consumers eventually respond?
Well, I think the key in all of this is the job market. And if we really start to see unemployment tick up, that's going to really impede on consumers' ability to spend.
That's Wall Street Journal reporter Suzanne Kapner. And that's your Money Briefing. I'm J.R. Whalen for the Wall Street Journal.